disappointing. Only Google has really had genuine tailwind, but I would argue actually the best move so far has been from Amazon. So let's size that all up here. Okay, so let's begin. Now, we just had a pig in the python moment where in the last 30 hours that we literally were drinking from a fire hose, from Mag 7 earnings to 4 central banks. The dust is settling now. We're only still waiting for the reaction here on Apple. But now, yesterday I was live online and I said, listen, we're going to come back today to size it all up. Let's see what it's like on the other side of all of this news. Or did anything change on the macro scale? What is it that you need to know is happening, and what does it mean for your portfolio? So let's dive into it. So what I want to do is start off here by just looking at the chart of the S&P 500, and we're down about 44 points today. A little bit of a down day. Obviously, wind being taken out of the sails. The Fed not so dovish. I mean, I wouldn't call it a crazy pivot. But simply, the market was pretty much banking almost 100% certainty of a December cut. And now it's gone to maybe a 2/3 odds of a cut. And we're asking the question of how really dovish is the Fed actually going to be? It had all sorts of impacts, but I want to talk specifically right off the bat about the Mag 7. So let's just quickly go through the ones that happened yesterday. So Meta was the biggest disappointment, and it technically is quite significant. Whether some technician wants to, call this some sort of mutated two-headed head and shoulders pattern, the one thing I do want to highlight is it broke a pretty substantial level. In the end, for 3 months, it remained trade range bound, and this gap legitimately broke it below that trade range. Therefore, we're now trading outside of the high volume fair value zone that was established. This clearly leaves the window for further distribution to be happening in Meta. Now, so this is a one blow. The other one that was a blow to the market was literally Microsoft fading off its highs. Now, in fairness, I'm a little more neutral on what's happening here on Microsoft, because realistically, I don't think it had any business 2 days ago trading up to $550 for that double top retest. And so, we're just slowly approaching the trade ranges that we've had for the previous couple of months. And so I wouldn't actually say there's real technical damage yet on Microsoft. Maybe it gets bought on dip, but certainly the earnings were not momentum to the upside. It did spur profit taking, and that has led to a little bit of a softness there. The one that did beat was Google, and Google went with a gap higher. As soon as it loads here, Google gaps higher and more or less held the gains. Let me just refresh this. And more or less, Google held the gains. Just loading. There we go. Giving a little bit of it back. The only concern here is this approaching what is an exhaustion gap? Why? Because the gap higher off this flagging formation finished a measured move, the rules of symmetry, and so the what I'm trying to build for all of you as a puzzle is the fact that the market has been deteriorating in its breadth, and these Mag 7s have been the leadership in the markets. The entire theme of the market has been anti-dispersion trade. It's been anti-market breadth. It's basically a breadth deterioration. I'll pull up a chart on that in a moment. And it's been max concentration into a small basket of stocks that are these mega caps, right? Like these Mag 7s are now greater than 1/3 of the market capitalization of the S&P 500. That means as go these handful of stocks, really goes the whole S&P. And this is why we're concentrating on these earnings and recognizing that, well, even though Google gapped higher, does Google have room to keep going higher. Now, I would be a little bit skeptical that it has huge upside from here, but the one stock that does is Amazon. So Amazon right now gaps higher. It's in the pre-market trading around $250. This is probably the most bullish of the Mag 7s now. Why? Because out of this sideways consolidation after a primary bull phase, you have a breakaway gap higher that is pretty much trading at 52-week highs. If the bulls can hold this overnight, we're in a situation where the follow through could be a move to 270, 290. This is probably the one Mag 7, in my opinion, right here, that actually has some legitimate room to follow through. And so this is the one I feel, if you want to be a bull focused on upside momentum, this is probably the one you should be concentrating on that front. So we're still waiting for Apple. We'll talk about Apple as soon as it pops up, and I think that's the important one. But the one thing I want to leave before I get into this understanding of the breadth of the problem we're seeing in the market is I want to touch on semiconductors. I'm going to start off with SMH, and then of course the behemoth in NVIDIA. So the SMH, which is the semiconductor ETF, has been the strength, the momentum, because it wasn't just NVIDIA rallying, it was AMD rallying, Intel rallying, Qualcomm gapping higher. Like, we had literally the entire semi space having huge flows. This AI story concentration just continues. And so right now, this continues to arguably be bullish. That room to go to 400 on the upside. And when you look at NVIDIA here, you can observe that with this breakout on the upside, it hasn't really been giving anything back. It still can actually act as the general, the leader, and push higher. So you have these semiconductors, and this is the point, is that if these Mag 7s, if we we'll see where Apple reacts, but if we are losing 3 or 4 of the Mag 7s and they're stalling out in trade ranges or going through some distribution of some sort on the downside, this becomes problematic because the concentration will just continue. What has been the problem? I want to just illustrate the problem of dispersion and breadth. Dispersion being that you're not getting the whole market participating together this way, and more importantly, the breadth of the market is deteriorating as more and more stocks are actually breaking below their 50-day moving averages to depict downtrends. Now think of it, the S&P 500 trading at all-time highs, stone throw away from 7,000, huge upside momentum, and here we are with 41% of stocks in a bull trend. That is close to 60% of stocks are in a downtrend with the market up at its highs. This is the point of concentration. This is why I'm saying the Mag 7s are so important, because the Mag 7s and all of these semiconductor names have been the only part of the market that has been driving this market higher. And in order for the S&P to go to the next level, to see 7,000, 7,100 or more, it needs all of these things working. And this is where we're trying to solve this puzzle as to what is happening here. Like, to further demonstrate that, this is the S&P 500 equal weight chart. What you can observe here is it pretty much failed to make a higher high on that retest and is already deteriorated back to near the mid-October lows. So this again is really showing that the breadth of the market is deteriorating as that without the concentration into these mega caps. Now, I'm not going to go outright bearish because I need to first see that these stocks are turning, but it is now becoming incredibly important to watch what happens on NVIDIA's earnings in a few weeks, right? So, it's entirely possible that NVIDIA is going to rally in the weeks to come to its earnings, but its earnings are coming out on the 19th. The interesting thing about that is we have our option expiration for the November monthly OPEX coming within days of NVIDIA's earnings. And so we have a scenario where, even if the market here can pull off several weeks of, the market maybe even perpetuating some of this momentum, if we are at a stage where NVIDIA has exhausted all of its upside move and there's a lack of participation by the rest of the Mag 7s, it could be an incredibly volatile November OPEX. And that so the way I'm approaching this from this context is, right now I'm not overly hedged up yet on my portfolio. Overall, the long positioning has got a little bit of room, but it's going to need to be hedged. There's going to be a point here where this deterioration of breadth is going to become a problem, and so we're watching here. Right now in the pre-market, Apple is gapped a little bit higher. We're going to see whether or not this Apple earnings is going to be a bullish or a tailwind or not for the markets here on the short term. Now, I want to now pivot a little bit. So, point being here, the S&P, it's very suspect. The rally is built on a very light foundation, and now the S&P has a cushion. The systematic traders. Remember, we talked about this in a video over the last couple of weeks, but systematic selling to the tune of $100 to $200 billion can at any one point come in, and has nothing to do with fundamentals. It has nothing to do with the bull thesis. It's only about whether or not these systematic strategies are forced to deleverage. And the beautiful thing for the bulls on the short term is that almost all of that deleveraging triggers are below 6,700, and most of them are actually below 6,600. So the S&P can easily take a 3 or 4% hit and not trigger these systematic traders. And that actually is a plus for the bulls on the short term. And this is why I don't feel that I want to be too much of a short-term alarmist, where we need to see where the markets are running much closer to the edge of the cliff, where that kind of systematic selling can create that air pocket underneath the markets. The one thing for sure is that volatility is low right now. We're down in the 16, 17 handle. All of that boogeyman volatility premium that was coming in, driven by regional bank stresses and other things, has now been completely pulled out. And if the market settles in here and realize volatility calms down, then overall the feedback mechanism of the vol targeting fund selling is also going to be benign. And that basically means that there's at least a very reasonable chance that the market can still crawl a little bit higher and or stay settled in an air pocket. The real fireworks at this point looks like it's going to be pushed into the end or the middle of November, where that NVIDIA earnings and OPEX cycle window are actually occurring. So let me just wrap things up by just talking about these central banks, because when we were live streaming yesterday, it was only about the FOMC. It was only about the fact that the Fed was taking a little bit of that dovishness out of the market. But we had the Bank of Japan come out and the ECB, and it's worth noting what's happening here. After the ECB came out, the euro's been weakening. We're actually at the edge of a cliff. Not only have we spent 2 weeks consolidating below the 50-day moving average and every rally failing below a fib zone, we're now at a situation where all we need is a euro to have a little push over that edge of the cliff, and we may have a drop in store. If that's the case, as an example, even if we just did a 50% retracement of this entire move, would be returning back to the April-May lows around 111. If that was to happen, that could be a quick 400 pip swing in the currency markets. Now, what supports that bullish U.S. dollar is that the pound sterling has already broken down. It looks like a very similar chart, but the pound sterling has already been breaking those key levels, and even now has had its first closing below those July lows. So there's structural weakness in there. Bullish US dollar, bearish pound sterling, euros weak. But then the Bank of Japan came out and it rocketed to a fresh the US dollar to a fresh new high. This entire pullback on the yen was a 61.8 retracement to the 50-day moving average. This break to a higher high measures out to moves 156 on the upside. And so here we have a US dollar rally. And on top of that, the after Bank of Canada had a very small fake out to test the 50-day moving average, and looks like a bull flag continuation for a potential breakout on the upside of the US dollar. So when we look at that US dollar in the post-central bank period, it's actually setting up like the US dollar may attempt to break out here. You gotta pay attention to this. Why? Because the entire reflation trade that's been working all around the world for the last 6 to 9 months has been anchored on the back of a weak dollar. Everyone's super bearish. It's a consensus thing to be bearish the US dollar. And if the US dollar creates a counter trend squeeze here, it is going to be a disruptor in the intermarket space. And inevitably, if there's enough disruption in the intermarket space, it could spill into equities. And so let's watch whether that US dollar on a relative to other fiat currencies has that bull breakout. The other thing to highlight is that obviously in the post FOMC period, what we've seen was generally a rise in yields, and it's been right across all durations. Not only did we see about 10 basis points pulled out of both short-term SOFR futures as well as the one-year SOFR futures, but as they're basically taking a little bit of the probabilities of a December cut out, but we've seen basically 10-year yields and 30-year yields both rising. And so this also is a little bit of a short-term stress point. Now, I don't actually think that this is yet a reversal of trend. And one of the puzzles to solve here in the next week or so is that will we see that the 10-year fades back down to the lows and goes back down below 4%? Or is this going to be a low for the bonds as they have come down and retested those April yields? It is actually pretty significant, because if we're going to go into a bigger risk-off cycle on an intermarket scale, the traditional intermarket relationships have the US dollar rallying and yields declining. If we see that the US dollar fails to break out and yields are rising in that environment, then we could end up seeing that things calm down, and actually the market is going to have less stress on it. So a lot of really interesting things to keep a close eye on that. Finally, I wanted to just touch on Bitcoin and gold. I wanted to quickly just highlight that Bitcoin had a rally that attempted to close above that 50-day moving average, which was directly a test into the Fibonacci zones, and it rolled right over and trading right back down to these lows. This is a very heavy chart, and when we're talking about risk assets, this is trades like a risk asset. So the fact that we're seeing distribution on this, and even especially since we're seeing a potential US dollar breakout, can't be ignored. In addition to Bitcoin selling, obviously gold's been in this correction. We've done videos already on this. We're getting a bounce, but the bounce is likely to be contained to 4,200. There is a typical corrective cycle where this A to B bounce happens, usually a 50% retracement. Sometimes it could go all the way for a full double top retest. I'm a seller on a double top retest. At least I don't want to assign a high probability to it. More likely than not, we're going to spend the rest of the year in some sort of a consolidation period. That is, I remain big picture super bullish gold. Don't want to say anything bearish other than it's normal for there to be consolidation periods. Gold did it 4 times in the last year and a half, and expecting gold to consolidate again is just within the way gold always behaves. Overall, I think that it will result in a bullish move next year in gold. But the idea that gold continues into a strong year-end finish I wouldn't assign a high probability to that. It's far more likely that you're going to get chewed up in trade range like price action. So in essence, I feel like while we want to be a little bit cautious on equities, there isn't anything super alarming. We'll definitely be watching how their Apple actually. Let me just touch on it. Finally, Apple came out. It's gapping a little bit higher. So at least Amazon and Apple are actually helping out the market on the short term. S&P futures popped about 20 points after Apple's release. So this is at least more neutral, right? With the fact that 3 of these 5 Mag 7s actually were gapping higher as opposed to down. And so at least they're going to continue to do their job in holding the markets up. It would have been far worse if we saw, 3 or 4 of the Mag 7s all getting hammered. At least right now, it's only really Meta. I mean, I wouldn't even argue, even though Microsoft dropped, I wouldn't really call Microsoft in a downtrend. And so really, overall, the Mag 7s have come in line and are not doing anything overly alarming. So the urgency to hedge is not that important, at least at this moment. All right. So that's where we'll wrap things up. Thanks everyone for joining me. We'll keep you all up to date here on the channel. If you want to follow along what I'm doing every single day, the link is in the description below to join me at Big Picture Trade.